Maria saved $200 every month for 5 years. Not once did she miss it. She watched the number go up and felt good about it. She had no idea she was losing money. In those same 5 years, inflation had quietly eaten the equivalent of 8 months of her savings. The account balance went up. What she could actually buy with it went down. Think about it like this. Say today you have enough saved to buy 100 bananas. Next year, bananas cost more, but your savings did not budge. So now you can only buy 96. The year after, 92. 5 years later, you are down to 80 bananas. Same money, less life. This is the thing nobody tells you when you open a savings account. Stay with me, because by the end of this video, I'm going to share with you a stock that went from 500 euros to 10,000 euros in 4 months, using only public information, and I will show you exactly how to find the next one. Before anything else, before you touch a single stock, 2 things have to be in place. First, get rid of high-interest debt. Credit cards charging you 20–25% a year. There is no investment that reliably beats that. None. Paying off that card is a guaranteed 25% return. You will not find that anywhere else. Second, build an emergency fund. 3 to 6 months of expenses sitting in a high-yield savings account. When the market tanks, and it will, you need to be able to wait. No cushion means you sell at the worst possible moment. The emergency fund is not exciting. It is what keeps the rest from blowing up. Once those 2 are done, you are ready. And this is where it gets interesting, because the strategy most people think they should use has a problem almost nobody wants to talk about. Here is a number that should bother you. If you put $100 a month under your mattress for 30 years, you end up with $36,000. Inflation has been chewing on it the whole time. You saved diligently for 3 decades and came out behind. Now, take those same $100 and invest them at the S&P 500 historical average of 8 to 10% per year. After 30 years, you do not have $36,000. You have between $135,000 and $180,000. Most of that money is not money you ever earned. It is money that came from money making more money. Compound interest. No overtime, no negotiating. No showing up. Einstein called it the 8th wonder of the world. He was right. So the answer is obvious, right? Just invest in an index fund and walk away. Here is the part most people skip. Buy an S&P 500 ETF. You have heard this so many times it sounds like common sense. And honestly, it is not wrong, but there is one thing almost nobody tells you. The return you get depends almost entirely on the price you pay when you get in. Right now, the market is at 22 to 23 times earnings. High by historical standards. JP Morgan, Bank of America, Apollo, Invesco all land in the same place. Expected returns over the next 10 years somewhere between plus 1% and minus 4% per year. And this is not theoretical. From 2000 to 2012, the S&P 500 returned basically zero over 12 years. 12 years of patience for nothing. Index funds still make sense, especially if you already have real capital and a long time horizon. But if you are just starting out, there is a better path, and the person who pointed me toward it is the same person who tells everyone else to buy index funds. Warren Buffett has spent years telling regular investors to put their money in index funds. And then you look at his actual portfolio: Coca-Cola, Chevron, American Express, and there is not one S&P 500 ETF. Not one. He has said that if he had less than $1 million, he would focus on small companies because that is where the real opportunities are. The data lines up. Over the last 90 years, the S&P 500 returned about 10% per year, which turns $1 into roughly $500. Small cap stocks returned 13.5%, which turns $1 into roughly $8,000. 3.5 points does not sound like much. Over 90 years, that is 500 times versus 8,000 times. A $200 million fund cannot buy a stock that only moves $8,000 a day, meaningless position size for them. So they ignore it. You can get in where they cannot. That is a structural advantage, not a consolation prize. 3 places I actually use. Dataroma.com. Every quarter, this publishes what the best investors in the world are buying. Free. For small caps, I also follow the Yellow Brick Investing newsletter on X. Screenshot anything interesting, drop it into Claude or ChatGPT, and ask it to explain the investment thesis for that stock. 60 seconds, real analysis. Buydigest.com/HCHF. and a database, letters from fund managers who have been beating the market for decades. Upload 1, ask AI to break down the thesis on each stock mentioned. Years of expertise, plain language, minutes. Do it yourself with 4 questions. Ask any AI. What growth is expected in this sector over the next 5 years? How has this company market share changed over the last 5 years? Has it grown faster or slower than its sector? What is the forward valuation? And is the debt load high or low? I ran this on Visa. Card market from $1.8 trillion to $18 trillion. Market share growing. Fair value between $368 and $400 a share. Used to take an analyst 2 days, now 5 minutes. But the biggest returns do not come from great businesses. They come from situations where the market is clearly, provably wrong. If you are liking this video, subscribe and press the like button so you can learn more about finances and investments. When a company goes through a structural change, a split, a spin-off, a relisting, the market is slow to catch up. That lag is where you want to be. SK Hynix, Korea. RAM manufacturer, almost unknown in the West. Trading in Frankfurt at roughly 1,000 shares a day. Fundamentals, 5 times earnings, 0 debt, while the United States market sat at 20 times. Then a NASDAQ listing was announced, $569 to $1,500 in 4 months. A company that was cheap because of where it was listed, not what it was worth. Lionsgate and Starz. Company splitting in 2. At around $7 a share, you were getting Lionsgate Studios, worth $6 to $7 on its own, meaning Starz, a real TV network with subscribers and cash flow, was priced at 0. Starz went public at $10, hit $28. 300% in 4 months. Everything was public 6 months before. You just had to look. These show up 3 to 6 times a year. You do not need to catch all of them. Buffett once said his firm focuses on making good purchases, not good sales. That stuck with me. Most of your return is locked in the moment you buy. On buying, manage risk before chasing returns. Spread across 30 to 40 positions while you are learning. Cover at least 6 sectors. Only invest money you genuinely do not need for 5 to 10 years. On selling, sell when you have found something better. Sell when your original reason no longer holds. Every 3 months, ask yourself whether you would buy this today if you did not already own it. Honestly, no means sell. Maria was doing everything right by every rule she knew. She just did not know the balance was lying to her. Now you do. The goal is not a bigger number. It is more purchasing power, more bananas. Compound interest is real. Small caps outperform for reasons that still apply. And the best returns are usually hiding inside situations that look boring from the outside, which is exactly why the price is wrong. If this was useful, subscribe. Next video, how banks get rich off your cash and how anyone from anywhere in the world can use that same system to build wealth instead. See you there.